increasingly used ETFs in their portfolios for a broad range of strategic and tactical functions. In 2018, insurance companies continued to increase their use of ETFs, and in spite of a market correction in the fourth quarter, held ETF assets in line with long-term growth trends. Hi, I'm Kelsey Stokes from S&P Dow Jones Indices, and here to discuss how insurance companies are using ETFs are Raghu Ramachandran, head of the Insurance Asset Channel at S&P DJI, and Kelly Sweppenheiser, head of Pension and Insurance General Account Solutions at Vanguard. Raghu, Kelly, thanks for being here.
Thank you for having us.
Raghu, what trends emerged when you were going through the analysis for this year's report?
So in this report, we saw three main trends come out. First of all, that in spite of the market correction in the fourth quarter, we actually saw that insurance companies have increased their use of ETFs in line with what they've been doing historically on long-term growth. Second was that mega companies, that is companies with more than $50 billion in assets, have increased their use of ETFs within this year. And the last thing that came out of the report is that insurance companies have systematically moved away from smart beta or factor ETFs in 2018.
And you touched on the mega company usage, but how do some of the ETF usage trends vary across company size, type, and geography?
So we break down insurance companies into four size buckets. Small companies are companies that have assets under $500 million. Medium companies are from $500 million to $5 billion. Large companies are from $5 billion to 50, and mega are from 50 and above. Historically, small companies have been using ETFs as a bigger portion of their admitted assets, in part because it's easier for them to access markets using ETFs, and they don't have the size or the allocation to make sense in a separately managed accounts, whereas mega companies had access to everything in the market. What we're seeing recently is that these mega companies have started using ETFs in their portfolio, and just because of the size of the assets they have, that'll be a material impact if they continue to do that going forward. In terms of types of insurance companies, we know that life insurance companies have the most admitted assets in the insurance universe, but historically and continues to be, the property casualty companies are the bigger users of ETFs within insurance companies. And geographically, 4 years ago when we did the first study, the use of ETFs was fairly concentrated in certain companies and in certain regions, but now we've seen that the use of ETFs is spread across the country, and in fact, New Mexico is the only state that doesn't have an insurance company using ETFs.
Great, thank you. And Kelly, how do these trends align with what you've seen from your clients?
Sure, I'll call out two things. I think the first would just be within the mega insurance space. 4 or 5 years ago when we were having conversations with insurers, they were still finalizing the use case on how an ETF would benefit them at that time. When we have conversations with the mega insurance channel today, they are already in a space where they know exactly when and where they're going to use an ETF and why. So it's really evolving that use case where we're helping them think through other potential strategies that could be beneficial to them, or making their trading strategies even more efficient. Secondarily, I think one of the other trends that Raghu touched on is really the overall growth, but we really look at transaction growth. ETFs are a tool for insurers to get access to whatever type of asset class they're looking to get exposure to, and we continue to see that overall growth be very strong. Almost $45 billion of ETFs traded hands last year, and that tool, giving them that efficient market access, is extremely important to them.
Thank you. Raghu, how did a contraction in the use of smart beta ETFs impact the overall ETF usage last year?
Yeah, certainly. So when we say smart beta ETFs, just to clarify what that is, so most ETFs, most indices are market weighted, like the S&P 500. What you have as smart beta or factor ETFs are where you have a factor that decides how the index is weighted or used. What we saw in the insurance space specifically is that insurance companies systematically sold out of smart beta on the order of 25 to 30% of their assets. And that's across the board, whether it's a life insurance company, a property company, a large company, or a small company. And that was a systematic move within the insurance space, which is contrast with what's happening in the general ETF market, where smart betas are actually growing. One of the interesting things that came out of our analysis was that if you exclude smart beta, that is, if you just look at traditional ETF usage within insurance general account, the AUM of ETF usage actually increased overall in spite of the market correction. So most of the market correction, or most of the AUM shortfall in ETF usage inside of insurance, happened exclusively because of the smart beta contraction.
Thank you. Kelly, what factors in the market do you think are informing insurance investors' decision making?
So insurance companies are notoriously sophisticated investors. So at the end of the day, it's going to come down to their specific needs and circumstances of why they're going to reach for a product. But with that said, I think one of the more macro issues that continues to evolve is just the evolution of access to corporate credit, right? I mean, in a great financial crisis post-world, I guess I would say, the inventories have changed. Where the brokers are actually obtaining these bonds has changed, and the fixed income ETF particularly has stepped in to serve a very important role in this market. As I think about a sports analogy, it's one of the things, if you think about soccer and you say, well, there's only 5 players out there, it's not a very exciting or efficient type of game, but when you put 11 on the field, it becomes electric. And as we think about the ETF ecosystem over the past decade, it's really become electric because so many different types of market participants, including insurers, have come to the actual table and been engaged in this market. So not only do you have traditional institutional investors like insurance companies, but you also have hedge funds, you have intermediaries, you have the retail public, and ultimately at the end of the day, what does that lead to? Much tighter bid-ask spreads and even increased access to those products, which often drive down costs and even make them more attractive.
And Kelly, you talked about transactions and how that's increased. Can you just go a little bit into how that affects fixed income ETFs and fixed income trading as well, and why that's beneficial to have a larger transaction volume?
Sure, because when it comes to fixed income ETFs, I think one of the common misconceptions is that every single trade is that the underlying bonds are affected, and that's simply not true. Through our research, we've been seeing that actual secondary market activity, just myself and somebody else essentially trading shares, is roughly 90% of the transaction volume, with only 10% going to the underlying primary market.
Great. And you touched on some trends already, but what other trends have emerged that you think may play out in next year's report?
Yeah, the thing that I continue to watch, particularly as the numbers had come in for the first quarter of 2019, is really that transaction growth, particularly within fixed income ETFs. We know that that's always going to be the core of all insurance portfolios, and ultimately what we've seen is that the larger transactions are continuing to gain in scale and size in 2019 thus far. To put it into terms, in 2018, the average fixed income ETF transaction was approximately $10 million. In the first quarter of 2019 alone, we're seeing the approximate average fixed income ETF trade is about $20 million.
Great, thank you. Raghu and Kelly, thank you both for sharing your insights today.
Thank you for having us.
Thank you.
To read our 2019 report about ETFs and insurance general accounts, visit us at spdji.com/insurance.